thank Paul for inviting me. He didn't give me a choice of what I could present, though, so blame him for the paper. I came here once before. That was a very different time from now. When I came, the Notre Dame had a fantastic football team. And a great coach, Jure Globalization. I spent time at the airport leaving Notre Dame, sitting with O.J. Simpson. At that time, Paul was at Ohio State, was a great colleague, and then came here, but has done an absolutely spectacular job at this institution. At the time, the New York Times, the NYC was U.S. capitalism were riding high. Now, obviously, we're in different times. So, what kind of got me going on this paper is you go and visit NYC. Now, when they're still an economist, you could do that. What always surprised me over recent years was this huge American flag. Well, when you think about the stocks traded there, a very large number of stocks traded on the NYC are foreign stocks. And at the same time, the NYC actually has exchanges elsewhere in the world that it is responsible for. So it seems odd. Led me to think about kind of the role of exchanges and the role of securities laws in a world that is a world with financial globalization. So what I'm going to focus on is first that with financial globalization and the technological innovations that have taken place, there doesn't seem to be that much role, non-legal reasons for national stock markets. But at the same time, the legal reasons for national markets really haven't disappeared, and I will focus on securities laws enforcement. Shows that those laws do matter, at least from my perspective, that they affect a lot of things in a country, going from firm size, distribution of ownership, the valuation of firms, and so on. The final point will be that in a world with financial globalization, it gives choices to firms as to which securities laws they will choose apply to them. And I would argue that that is, within limits, is a good thing. So, first, we'll look at this technological progress on the impact of financial globalization. Then the paper has a very simple model to make my point about securities laws. And then I will talk about the advantages and disadvantages of issuer choice. If you look at how the world has evolved, in 1946, after World War II, most countries were closed to equity flows. You jump to 2008, there's a question about how it's going to be going forwards, but clearly at this point, countries are wide open to equity flows. That's not only the developed countries, but many emerging countries are also wide open. So it's a very different world, and it has lots of implications for us. Okay, this is just one implication, and one piece of evidence of the changes. It's the Quinn Index, which measures legal formal obstacles to flows, and you can see how it has increased. Now its maximum is 14, and we're pretty close to the maximum. The other piece of evidence that I have here is just a dramatic increase in the gross foreign equity flows to and from the U.S. Now you can see this increase having been pretty dramatic. It just didn't exist when you go back before 1980. No, it's obviously very big. That also, people have talked a lot about the Philippon papers. That also coincides with a dramatic increase in the importance of the finance industry in the US, and I don't think the two are unrelated. Those barriers to cross-border flows have disappeared, but historically, the local trades in local markets had lower transaction costs because of the existence of those barriers. It was costly to go abroad to trade shares. But if you don't have those barriers, if you have increasing returns to scale in trading, then you would just expect that the trading would locate at one place for a stock, and everybody would trade that. As long as there are some barriers, then there is a trade-off between the cost of the barriers and the benefits of increasing returns to scale. This little graph kind of tells the story. If you have increasing returns to scale and you have a small country and a large country, the large country is going to have lower trading costs than the small country. The incentive is for the people in the small country to move on trade in the large country, but only as long as the benefit that they make is greater than the cross-border costs. If those cross-border costs having disappeared, then you expect this concentration of trading. So as long as we have small cross-border costs, then you expect this to happen. There is literature in microstructure and multi-market trade, and you might say, well, but that tells us that that's not going to happen, that people will keep trading on different markets. Certainly that's going to be the case in the short run, but when you read those papers, I'm sure that Maureen may correct me.
Never, Rene, I'd never correct you.
But all those papers have assumptions that seem to be kind of artificial and don't really describe what you expect to happen in the long run in terms of multi-market trading. All the papers make assumptions about a limited transparency. You trade, you don't see what, if you are on one market, you don't see what happens on the other market immediately. Okay? That, certainly historically made a lot of sense. In the sense that information was flowing slowly. But no, if you are in Zurich, you can see what's happening in New York just about at the same time as if you were in New York. Okay, so my conclusion is that you want, all those rules that those papers assume that restrict transparency or kind of assumptions that they make, you think that over time they will just going to be very important. So I don't think that multi-market trading models kind of go against what I've been saying. Now, in terms of technological innovation, okay, the big thing is electronic trading. That really removes the need to be at the exchange. It's not clear what the exchange is. It's kind of becomes a computer. The computer could be anywhere. Now, I understand that there is competition among exchanges for how small of a fraction of a second it takes to trade, then that might stand a little bit in the way of what I'm saying. But I don't think that that's not very important in terms of the overall scheme of things. Now, market makers don't have to be at the exchange. Traders don't have to be at the exchange. And the physical location of the exchange really doesn't matter. So once you get to this, assuming that all this is a reasonable approximation of how the world, maybe not quite works like now, but it's kind of the natural evolution of where we are, then physical location of exchanges could only remain important for legal reasons or maybe some behavioral reasons, okay, that people for some reason don't want to trade on foreign exchanges and so on. So the legal reasons, one important one where location matters, and that's the one I'm going to focus on, is the role of securities laws. Securities issued in different countries are subject to different securities laws. Securities laws also affect the securities that can trade within a country. Not everything can trade anywhere because of securities laws. So what I want to focus on is kind of the benefit of securities laws in this context. They also have costs, and I want to talk about them. But so I will focus on one aspect, which is disclosure. I'm talking about a very simple model of disclosure. Okay, so we have an entrepreneur. The entrepreneur chooses to have an IPO. And it's a situation where ex ante, it's optimal for the entrepreneur to commit to disclose everything. Because that's going to increase the price of the shares at the IPO. Okay? But subsequently, the entrepreneur learns something about the production process of the firm. And if the production process turns out to be bad, it's optimal, in a neoclassical world here, to stop production. Stopping production is costly for the entrepreneur because then he loses private benefits from continuing production. So there is a cost to the entrepreneur of disclosing the truth, and that's what I'm going to focus on. And so if you in the model, the benefit of compulsory disclosure is that it enables the entrepreneur to commit ex ante to disclosing later on something that exposed the entrepreneur would not want to do. So it resolved that problem. Now we'll talk about the fact that problem could be resolved in other ways. And then the question is, when is it that securities laws are the right solution as opposed to other solutions? Just so that you know that it's worth it to listen to me for the next 15 minutes when I talk about the model. Okay, what are the implications from this? Okay, well, the conclusion is that the countries with better securities laws in the model end up with more public firms, end up with public firms that are more highly valued, more disposed ownership, more foreign investment, higher operating performance. And in this model, firms from countries with poor securities laws want to list in countries with good securities laws. And now, if one important implication of this, and we'll get back to it, now is that there is this pressure to kind of make the securities laws softer in the US, but in this kind of model, that's not a good thing to do because you want, if you have a country with the good securities laws, having those laws has value in bringing in firms from foreign countries to the country. So we'll talk more about that. Now, the model also allows us to talk about this issue that securities laws might have deadweight costs. Okay, and there's been lots of discussion about that in public policy. So if they have deadweight costs, you could still see foreign firms go to the countries with good securities laws, but only some firms will go. Those will be the most productive firms, okay, because it's going to be beneficial enough for them to go because it will pay for those deadweight costs. But deadweight costs will reduce the number of public firms. The low productivity firms from good securities laws countries would like to IPO elsewhere. Like you might want to IPO in London. And then the high productivity firms in the good securities laws countries will want to stay there. So let's see how this works. And we have an IPO at date 0. At date one, the insider learns productivity of technology. Now, in neoclassical world, you stop production if you have the bad outcome. But here, you don't want to stop as an entrepreneur, if you can avoid it, because you get private benefits from continuing. At day two, you have a liquidating dividend. Then at that time, insiders consume private benefits. Now, there are many papers that focus on private benefits and consumption of private benefits. What differentiates this from those papers is all those papers are about day two. Okay? Here we are all about date one. We're not going to worry about day two. Okay? So the issue here that I want to focus on is the role of disclosure and the role of securities laws in preventing continuation when it's not optimal. So the model builds on Schleifer and Wolfenson builds on an earlier paper of mine. Okay? It's a situation where the entrepreneur has wealth, the entrepreneur has a good idea, a good project, but doesn't have enough funds to undertake the project by just with those funds. It needs to go public to raise funds. And then the project has a random return. And here, what goes on is at the start you have an expected return, but then you learn more about the expected return at date one. At date one, you might learn that the expected return is below the risk-free rate or is above the risk-free rate. And obviously, if it's above the risk-free rate, you would want to continue. If it's below, you would want to stop. Okay? And then at day two, the entrepreneur gets to extract private benefits. As in the earlier papers I mentioned, and as in much of the literature, there is a cost to extracting private benefits. Okay? So I'm not going to spend much time on kind of the details here, but the point is at day two, the entrepreneur has wealth that results from having invested in the project. The entrepreneur has ownership, gets dividends from that ownership, but in addition, the entrepreneur gets private benefits, but there is a cost to those private benefits that also trades off between the cost and the benefits. At date one, that's the key date for the model, is whether the entrepreneur decides to start production after having learned more about the technology. So at that point is where the interests of the shareholders on the entrepreneur differs. Those interests differ. Okay? At date one, the entrepreneur wants to start just about no matter what, within a range of expected returns, whereas the shareholders don't want production to start if the expected return is below the risk-free rate. Okay? And so ex ante, at date zero, the entrepreneur would like to commit never to start production in the bad state. But now nobody knows what the entrepreneur is the only one who knows whether you're in the bad state or not. Okay, so that creates a difficulty. You would like the entrepreneur to disclose whether you're in the bad state, but obviously the entrepreneur doesn't want to disclose because the entrepreneur wants to keep producing no matter what. Okay? So in the papers, there's lots of discussion why disclosure is not going to happen. If you have securities laws that force disclosure, then that's one way to get the entrepreneur to commit to disclosure. And if you have that, then the shares sell at a higher price. The reason they sell at a higher price is that you don't have production in the bad state. Okay? But when you think about this, disclosure alone is not going to do it. Okay? Because you could say, well, we're in the bad state and I'm going to produce anyway. Okay? So you need disclosure, plus you need the ability of the shareholders to intervene based on what they learn. Okay? So you need the two things. You need disclosure, you need a legal regime that allows the shareholders to intervene. So we need two things. Okay. So at date 0, now it's optimal to commit not to extract private benefits. It's optimal to commit to start production only if we have the good outcome. Now, starting production with a good outcome is not time consistent. You could say there's a whole range of private solutions to this problem. Okay? You could have more insider ownership, but we already saw that just because of the wealth limitation of the entrepreneur, that's not enough. You could have, lots of people keep saying, well, you can have voluntary disclosure, but in this context, it doesn't work, okay? Because you always say, yes, I'm going to disclose, and then don't do it. There are various contractual solutions. You can have a bond, reputation. Reputation here doesn't work because it's a one-shot affair. No, it's not like the entrepreneur keeps stopping you from disclosing. So reputation doesn't work. You could have a contract where the entrepreneur says, I'm going to have an auditing firm that is going to come undisclosed. But that has its own set of problems. Somebody has to be able to enforce the contract, and you have to find ways to make that contract credible. You have to make sure that the entrepreneur can't enter the contract and then fires the auditing firm. So none of those solutions end up in the specific context of the model to work well, or to work to such an extent that kind of securities laws that force disclosure would not be better if the securities law, and that's a big if, requires disclosure of just the precise piece of information that needs to be disclosed. Okay, so that's what's the problem. That's a big issue here. So a law that mandates disclosure of the expected productivity works. Okay, as long as once shareholders learn the productivity, they get to intervene. Okay. So the question, we already talked a little bit about that. What is it that the securities laws solution will dominate the private solution? Well, you need to have law enforcement costs of the law. And essentially here it needs to be disclosure of things that the entrepreneur himself or herself would like to disclose. Okay? And so when you think about the role of disclosure law here, it's a way to tie the hands of the entrepreneur to doing things that they would want to do in the first place. Now, at time 0, they would love to be able to come into disclosure, okay? But once they get to time 1, they also would love not to do it. Okay? But it's beneficial as of time 0 to come in credibly to do it, and the securities laws allows them to do it. Okay? But that requires law enforcement cost of the law. So when is it that the securities law might do things in a way that doesn't help? Well, if the public enforcement of the law is very costly, okay, then the benefit might not be enough. There's obviously the concern that insiders might be punished when they shouldn't be, and then there's a concern that the securities law might require inappropriate disclosures. Okay? It's clearly in the context of the model, if the securities laws forces disclosure of the true expected productivity and nothing else, it makes the entrepreneur better off. Okay? Now, the last point that's important to make here, okay, is in this model, the beneficiary of the securities law is the entrepreneur. Okay? Because it allows the entrepreneur to commit to doing something that they would want to do in the first place. Without the securities laws, the share prices are low. Okay. Now, I will talk briefly about kind of a different direction that I could have gone on kind of a different set of concerns, okay, which is that disclosure can affect expected returns. Okay, Maureen has papers to that effect. Here, the expected returns are just the risk-free rate. Everybody is risk neutral. The disclosure has no impact on the risk-free rate. Okay, so, but it does have an impact on the prices because the expected cash flows are different with disclosure than without. So now we can look at the cross-country implications of this. Okay, suppose that you have two countries. You have a country with good securities laws and one with bad securities laws. Okay, the country with good securities laws requires disclosure of exactly the right thing, which is the productivity, the true productivity at date one, and then enables investors to act upon the disclosure. Okay. And in both countries, and so there are no additional costs. Now, this is the dream world of securities laws because there are no deadweight costs for country G. And then we have a continuum of firms. Okay. So what do we get in this? Well, the shares in the country with the good laws are going to sell at a higher price. Okay. So that's clearly the starting point. They sell at a higher price because you are never going to produce in the bad state. Okay. Now, greater insider ownership makes it more likely that you are not going to produce in the bad state because you bear more of the cost as an entrepreneur producing in the bad state. Okay. So greater insider ownership is partly a solution to the problem. It's not a complete solution because of the limitation of the wealth of the entrepreneur. She will always want to raise funds outside. Okay. And so in the countries with bad laws, you are going to see more concentrated ownership. Okay. Tobin's Q is going to be lower in the country with bad laws because share prices are going to be lower. The wealth constraint of the entrepreneur, together with the fact that more insider ownership means that you are less likely to produce in the bad project, is going to lead to smaller firms in the country with the bad laws. Okay. In terms of output, in the country with the good laws, you only produce when the project is good. In the country with the bad laws, you end up producing sometimes when the project is bad. Okay. So you have lower output. Because now this inability to commit, you end up in the country with bad laws to have firms that can't go public because there's no way for the entrepreneur through ownership to commit enough that he's not going to produce in the bad project. Okay? And then we talked about ownership. And the last point is when insider ownership is high, obviously there's less room for, in equilibrium, for foreign investors to hold domestic shares. And so foreign investors invest less. Okay, so I talked about how this is different from kind of related literature. The related literature focuses on the cost of extracting private benefits at day 2. I am assuming that that's the same in all countries. Okay. So now the next step is what happens if you let firms choose laws. And you take a what? So I don't know how much. 7 minutes? Okay. So now let's have firms being able to choose securities laws. Okay? So firms in a country have the option of deciding to be subjected to another country's securities laws. Okay? Now, to look at that, now to get a key issue is, does the location of the firm matter in terms of the benefits it gets from securities laws from a country? Okay, suppose that you have a firm in Switzerland and decide to be subject to the securities laws of the US. Does it matter for those benefits whether you are located in Switzerland or in the US? Okay, there are papers in the literature that say, yes, it does, to some extent. Okay, let's assume that the location is not relevant, and let's assume that there is no cost to cross-listing. Okay. With those assumptions on what we have talked about so far, you would find all firms in country B going on cross-listing in country G, being subjecting themselves to the securities laws of the good country. I mean, of the good securities laws country. Okay, so if the U.S. is that country, you would expect all firms to come to the U.S. Now, if there is a cross-listing cost, okay, now remember, you expect them to come to the U.S. at the time of the IPO. Okay, once they have had the IPO and you make it accessible for them to come to the U.S., that's a very different story, because coming to the U.S. then would result in a wealth transfer from the insiders to the outsiders. Okay, so what I'm talking about is at the IPO, what would you expect to happen? Now suppose you have a cross-listing cost. Okay, in that case, only the firms in the country with bad laws would cross-list that have an expected productivity that exceeds some threshold. Okay, because what happens with the cross-listing here is that it allows you to take advantage of growth opportunities, which in the model essentially depend on the productivity. Okay, and so if you have low productivity, you have low growth opportunities, you are not going to get enough from the cross-listing to cover the cross-listing cost. Okay, so that's how it works. And so here, the firms that cross-list have a higher Tobin skew, because those are the firms both with the higher productivity, and because they have adopted the better securities laws, are less likely to start production in the bad state. Okay. So we expect a higher Tobin skew because of higher expected productivity, better investment decisions. What I mean by that is at date one, they are more likely to not produce if it's a bad state, then less consumption of private benefits, because in some states of the world, they don't produce. Okay. And so now if you look at historically what happened, now you have these dramatic numbers of cross-listings in the US compared to cross-listings on other exchanges. So you could argue that kind of based on this, kind of the equilibrium of cross-listings, it will be consistent with the US being the country with good securities laws from that perspective. If you look at the evidence in Tobin skew, it's also consistent with that. Here we have all cross-listed stocks. Here we have cross-listed stocks on major exchanges. You can see that there is a difference in the Tobin skew for the cross-listed firms. That difference is significant every year for the exchange cross-listed firms, and is economically significant on large as well. Now, the last related point is what if there is a deadweight cost of securities laws? Now, so far we assume that we were kind of in a world that was ideal for securities laws. Now we have a deadweight cost. You could think of the cost associated with stocks that people have talked about a lot. Okay, so what happens if you have those deadweight costs? Okay, then what we end up having in the model is that some firms are not going to go public. Okay, and that's the reason being that if you go public, it reduces the benefit to the entrepreneur from going public because the shares are at a low price. So some of them will just decide to stay private. But it also reduces the cross-listings that take place, because if you move from the bad country to the good country, the net benefit associated with that is going to be lower. It's like a bigger cost of cross-listing, and we saw that the cost of cross-listing is going to reduce the firms moving from country B to country G. Now, Paul told me to give this paper, but I cheat a little bit. This is from our recent papers that Craig, and Andrew, and I have on the registrations. Okay? Those are the registrations from the SEC from 2002 forward to 2008. And in 2007, the SEC adopted a rule that we don't like at all, which made it a lot easier to deregister. Okay? In the context of the model, you can see why the rule is not, has problems, which is that if you get to choose securities laws, there's more value to that if it's harder to then renege on your choice. Okay? And so the SEC in 2007 made it easier to renege on the choice by making their registration easier. Okay? But then what you see, you see in 2007 a whole bunch of firms that are registered. It's much more than kind of what it was historically. It would be nice to not have a couple more years. But 2008, you were kind of back to where we had been earlier. So it remains to be seen as to what the total effect of that rule is. Now, here we have now we talked about Q. This is the cross-listing premium that I showed earlier, but separating the exchange-listed firms and the registering firms. Okay, and you can see that the firms that have registered over this period of time have a lower Tobin skew than the ones that stay in the US. And so I talked about the fact that in the model, being cross-listed has value, it can have good growth opportunities. It turns out that the firms that leave have lower growth opportunities. There are other statistics that I could provide to show that. So from the perspective of growth opportunities, the good firms have been staying, the bad firms have been going. Now, so far we focused on firms from country B cross-listing in country G. There was much discussion about US firms going to London to IPO. Okay, and so if we keep with the US being the country of the good laws, what happens if you let US firms IPO in country B? Okay. What would you expect to see? Well, suppose you made it easy for US firms to cross-list in London, you still would have the high productivity, high growth opportunities US firm IPO in the US. Okay? But the low productivity US firms would then choose to IPO in London. So, now so far we looked at the case where I didn't see that. So far we looked at the case where securities laws had no impact on expected return. The expected return was a risk-free rate. Now, obviously, disclosure laws also affect expected returns. Insider trading, as some people here have shown, affect expected return. I had a couple of slides about that, but obviously, I won't be able to talk about them. But no, one slide was about marine, and then one slide was about earthbound. Both of them can speak for themselves. So the conclusion. Now, the reasons for the importance of national capital markets having to do with cross-border obstacles are disappearing. You would think that economies of scale are going to create a pull towards single location trading, that the location itself is not going to matter that much. But securities laws remain, the ways that national capital markets might be might be defined. They affect firm value, firm performance, and firm ownership. Now, their role is not going to go away, for a while. As long as the laws differ, there will be a role for national capital markets. And even with issuer choice, we would expect different national capital markets to persist. In the model, now what we saw is that, suppose you have complete issuer choice, but securities laws differ in the deadweight costs and differ in other dimensions, there's going to be a preferred habitat for different firms. Now, there's going to be different for different firms in terms of securities laws. And so you would still have different differences.
Thank you. Any comments? Questions? Yeah.
It might be beyond the scope of the paper, but I think it would be interesting to know what justifies any country to adopt a weak securities law under this situation. Because adverse election might be going on and they only attract poor quality firms for that country.
You have a number of different factors. Now, one of them is that a country might want to have poor laws because of the politics within the country. And there is some discussion of that. In the paper, the problem is, suppose that you have some kind of securities laws and then decide to make disclosure requirements stricter, that would benefit the entrepreneurs. Okay, so that you actually would go in the right direction from the perspective of the entrepreneur. That has adverse effect on the incumbents. So when you think of kind of changes in securities laws, they can have very different effect for people who aren't on the markets yet versus the ones who are. Okay? And so that conflict can explain a lot. But there are other dimensions, which is that, in the model, you need to be able to enforce the law. You need the shareholders to have access to be able to take steps. Now, and that's also going to depend on economic development. It's going to depend on the country's institutions. And so even if a country adopted exactly the same laws as the U.S. formally, that wouldn't be equivalent. Okay? Because, you might not have the auditors. Lots of things might be different.
Chester?
Yeah. He's in charge. Sorry.
So Rene, one observation that I have that's kind of very consistent with your framework is what I observed when this deregistration rule was being debated is that some of the parties pushing this, I think, took a lot of comfort, but I'm not sure that they should have. But a lot of the parties took a lot of comfort that the firms that were being allowed to be deregistered were, for example, primarily from Europe and not typically from Canada. And it turned out that Canadian companies didn't really care about being allowed to deregister, and European companies and European companies and European regulators were the ones screaming. So, and so I think that really kind of fits your story very, very well. That the folks who were obviously the folks who were allowed to exit were the ones who were insistent, and the folks who weren't allowed to exit, frankly, didn't care whether they could exit or not.
Take one more, John.
You said during your presentation, and you repeated one to answer the question, that disclosure without shareholder intervention, not under the case. I understand that within the conversatory model, but in a bigger picture sense, does shareholder intervention with their feet, through market prices, would that be enough, or do we need shareholders intervention, direct intervention?
Well, so now that's an interesting question, and one that I have been struggling with, one for which I really don't have a good answer. Now, obviously, shareholders can push prices down to reflect consumption of private benefits, but here, Now, the whole point of the law is to get to a level of commitment so that the shares don't get discounted, because that's valuable to the entrepreneur. And so, voting with their feet happens full strength here, but it has an adverse effect that the entrepreneurs would like to find a solution to.
All right, we got a late start today.
We have one more question.
Oh, go ahead.
I was just going to ask, I mean, I think your argument seems very cogent and convincing, but one could also wonder if there are substitutes to the securities laws vis-a-vis the design of exchanges and listing requirements that could accomplish similar sorts of things. I mean, Brazil, for example, put in sort of super listing requirements. And in part, I suspect, because the Brazilian security laws were not all that hot. But by supplementing them with exchange rules and whatever, you could actually undo the national security laws. Do you see that fitting into what you're doing?
Yeah, so I was concerned about that and still am as to how to exactly think about it. Brazil gets, as we mentioned, in that context. Now, the key difference is the ability to renege on the commitment. With an exchange listing, you can. With a securities law,
but you could be delisted.
It can be harder. Yeah,
but you could be delisted, in which case, that would enforce the ability of the exchange to force the company to behave.
Right. So the exchange can delist you, but you can also voluntarily to choose to delist on. So you can make the commitment to go to an exchange and say, then you raise the fund and say, oh, by the way, goodbye. It's harder to do with securities laws. Before this 12H6 was even harder to do. But so that to me is the difference.
Oh, sorry, one quick question. About private solutions. It's my uninformed impression that right now in the U.S., what's really the effective constraint on disclosure is private class action lawsuits, much more than the law. You know on that?
When you say constraint, that they limit disclosure or that they push to disclosure?
That they push to disclose, or that they must. If your stock price goes down and it's something you have to disclose, you're sued.
Now you could see in a world where the SEC is starved for resources that might end up being that way. That private enforcement would be important. I'm not sure that to which extent that's.
But the suits are about securities laws.
I'm sorry?
The suits are about securities laws. So essentially, it's just you've got a perfect enforcer, and this is just the way you put it.
Right.